All right, let's talk about AI. For what, the last 2 years, it's been the single biggest story in tech, right? It's been driving the markets to some absolutely insane new heights. But you know how it goes. Every boom sooner or later faces a reckoning.
So, the big question, the one everyone is asking right now, is pretty simple. Is the party over? I mean, are these cracks we're starting to see just a little wobble, or is this the beginning of a full-blown collapse? Let's dive in and break it all down.
Okay, so here's our game plan for this explainer. First, we're going to look at the insane investment boom that got us here in the first place. Then, we'll get into the first real warning signs that have everyone, well, a little on edge. After that, we'll dissect the risks, look under the hood. We'll explore 3 possible ways this could all play out. And finally, and most importantly, we'll talk about what all of this actually means for you.
All right, first up, let's set the stage. I mean, this AI boom, it wasn't just random hype. It was built on a very, very real technological revolution. It all kicked off with this perfect storm, really. You had these incredible leaps in deep learning. That's the tech that lets computers learn from just massive amounts of data. And at the same time, you had the explosion of cloud computing. This just unleashed a tidal wave of investment into the nuts and bolts, the core infrastructure. We're talking huge data centers. And, of course, the super powerful chips needed to run everything. And the companies right in the middle of it all? I mean, look at Nvidia. Their revenues went through the roof because, hey, their GPUs were the shovels and pickaxes in this new digital gold rush. And what did that lead to? Well, these sky-high market valuations that were based not really on today's profits, but on these massive, massive expectations for what's coming next. But lately, the vibe has started to shift. The whole narrative is changing, and some of the most influential voices out there in both tech and finance are starting to sound the alarm. And it started with these whispers, right from the very top. I mean, when Sundar Pichai, the CEO of Google's parent company, Alphabet, starts warning about irrationality and an excess of expectations, yeah, the market pays attention. This wasn't some random analyst. This was a massive signal coming from inside the house. And then you had the big financial institutions jumping in. The Bank of England, they didn't mince words. They drew a direct line to the dot-com bubble, warning of a sharp correction if all this enthusiasm starts to fade. Just hearing that comparison, that's enough to send a chill down any investor's spine. And to kind of complete the trifecta, you have a legendary investor like Mark Mobius being even more blunt about it. He pointed right at the fundamental problem. These huge valuations have to be backed up by real, actual profits. If they're not, well then a major decline isn't just a risk, it's pretty much a guarantee. And look, these warnings weren't just talk, they weren't just theory. On November 18th, 2025, we saw it happen in real time. A pretty significant sell-off hammered AI-related stocks, and it turned all those abstract fears into a very real, very painful market event. It was proof that investor confidence was really starting to shake. Okay, so what exactly are the risks that have these experts so worried? To get that, we really need to pop the hood and take a look at the anatomy of this whole situation. It really boils down to 3 main areas. First, you've got valuation risk. This is a big one. It just means stock prices are based on this perfect, rosy future that might never actually happen, instead of, a proven track record of making money. Second, there's operational risk. Think about it. Just because a company pours billions into building data centers doesn't automatically mean customers are going to line up to use them. And finally, and this one's scary, there's liquidity risk. This is the classic domino effect. All it takes is a few giant investment funds deciding to cash out and take their profits, and that could trigger a massive panic as everybody else scrambles for the exit at the same time. And really, at the very heart of all this is a concept called the capability realization rate, or CRR. It sounds complicated, but it's not. It's basically just a fancy term for the gap between what the market hopes AI can do and what it can realistically deliver, in the short term. The bigger that gap gets between the hype and the reality, well, the bigger the bubble. And what's the result of all this? A huge shift in market psychology. We're seeing what they call a risk-off sentiment taking hold, where over half of investors are now looking for safer places to put their money. It feels like the days of just blindly throwing cash at anything with AI in the name are fading, and fading fast. So, with all these risks on the table, the big question is, where do we go from here? Well, experts are basically seeing 3 different ways this could play out. Okay, scenario 1 is a moderate correction. This is kind of the best case scenario of the bad scenarios. The super overhyped stocks take a hit, but the solid companies with real businesses stabilize. Scenario 2 is the one people are worried about, a deep correction. This would be a sharp, widespread drop that could pull the entire tech sector down with it. And then there's the third possibility, the recovery scenario. This is where strong profits actually prove the doubters wrong, and investors come flooding back in, seeing any dip as a massive buying opportunity. And when we say a deep correction, what are we actually talking about? Well, some analysts, including Mark Mobius, have thrown out a potential drop of anywhere from 10 to a whopping 40% for some of these high-flying AI stocks. I mean, think about that. That's a staggering number.
All right, so we get it. Things are shaky. Which brings us to the billion-dollar question. What are you supposed to do about it? How do you navigate all this uncertainty? Let's try and turn all this analysis into some actual strategic takeaways. So what does this mean for your wallet? Well, if you're an AI or tech investor, the big message here is to start looking past the hype. It might be time to really focus on companies that have real-world applications and, crucially, are actually making real profits. Now, if you're a crypto investor, there's a different kind of warning. History shows us that when the big tech sector starts to get wobbly, it has a nasty habit of dragging down other high-risk assets, like crypto, right along with it. See, when fear takes over, investors tend to just sell off everything speculative. That makes diversifying your portfolio more important than ever right now. And that leaves us with the ultimate question, doesn't it? As we stand here, maybe on the edge of a bubble bursting, what's your move? Do you play it safe, protect your capital, and sell now? Or do you bet on the long-term AI revolution and see this potential dip as the buying opportunity of a lifetime? Honestly, the answer to that question is probably going to define portfolios for years to come. Thanks for joining me.